Most investors make one fatal mistake. They chase high dividend yields or pure growth and end up with neither. But what if you could lock in $4,200 a year in passive income and still build a $450,000 portfolio in 20 years? This is the 555 Dividend Strategy, a three-part investment method using 15 specific assets that solves the income versus growth dilemma forever. And the best part? It's already turning Harry's 500-month plan into a dividend machine. Let me show you how. This video is for informational and educational purposes only. It is not financial advice. I'm going to break down the exact 5-5-5 strategy that balances high dividend yield, stable growth, and capital appreciation. You'll see the current yields and performance numbers for each investment, discover how to allocate between 3 distinct categories, and by the end, you'll know exactly how to implement this strategy in your own portfolio. Plus, I'll reveal which ETF is currently yielding over 13%. But there's a catch you need to know about. Here's the problem most dividend investors face. They get trapped in the yield-chasing game. They see a REIT paying 8% or a covered call ETF yielding 13%. And they think that's the secret to financial independence. But what happens? Their portfolio value stays flat or even declines over time because they've sacrificed all capital appreciation for current income. On the flip side, growth investors chase capital appreciation but miss out on passive income streams that could compound their wealth. The 5-5-5 dividend strategy solves both problems by creating a balanced approach that delivers the best of both worlds. The 5-5-5 dividend strategy is brilliantly simple. 5 high-yield securities for maximum current income. 5 balanced securities that blend yield and growth, and 5 growth securities focused on capital appreciation with growing dividends. Think of it like a 3-legged stool for your investment portfolio. The high-yield leg generates the cash flow you need today. The balanced leg provides stability and consistent dividend growth. The growth leg powers your long-term wealth building through compound growth. All the investment data you're about to see comes directly from seekingalpha.com. It's the research tool I personally use. If you want to explore it yourself, there's a link in the description that gets you $30 off plus a 7-day free trial. Each category serves a specific purpose, and together they create a diversified portfolio that can weather different market conditions while growing your wealth over time. High yield category, the income generators. Let's start with the high yield category. These are your passive income powerhouses. Our first pick might surprise you. Altria Group, an MO, currently yielding 6.92%. I know what you're thinking, tobacco stocks? But here's why it works. MO has increased its dividend for 55 consecutive years. That's dividend aristocrat status, and with a payout ratio of just 77.54%, there's room for continued growth. Next up is Ares Capital, ARCC, a business development company yielding 8.41%. BDCs are required to distribute at least 90% of their income, which explains the high yield. ARCC has delivered a 10.43% total return over the past year. But here's where it gets interesting. QYLD, the Global X Nasdaq 100 covered call ETF, shows a distribution rate of 13.52%. Wait till you see the catch with this one. QYLD uses a covered call strategy on the Nasdaq 100, selling call options to generate income. But here's what most people miss. That 13.52% includes return of capital, meaning you're getting some of your own money back. The actual SEC yield is only 0.20%. This doesn't make it bad, but you need to understand what you're buying. Then we have JEPI, the JP Morgan Equity Premium Income ETF, with an SEC yield of 8.34%. This actively managed fund combines S&P 500 stocks with equity-linked notes, providing more sustainable income than pure covered call strategies. Finally, VYM, the Vanguard High Dividend Yield ETF, offers a clean 2.62% yield from actual dividend-paying companies. With $75.6 billion in assets and an expense ratio of just 0.06%, it's a cost-effective way to own 591 high-dividend stocks. Balanced category, the steady growers. Now let's talk about the balanced category. These securities give you the best of both worlds. PepsiCo, PEP, leads with a 4.02% yield and has increased its dividend for 52 consecutive years. Consumer staples like PEP provide defensive characteristics during market downturns. Waste Management, WM, Might sound boring, but it's yielding 1.40% with 8.74% annual dividend growth. Think about it. We'll always need waste management services, making this a recession-resistant business with 21 consecutive years of dividend increases. McDonald's, MCD, serves up a 2.36% yield with 8.73% dividend growth. The Golden Arches generate predictable franchise fees from over 43,000 locations worldwide, creating a stable cash flow stream that supports 48 consecutive years of dividend growth. For ETF exposure, DGRO tracks companies with consistent dividend growth, yielding 2.19% with holdings across 405 companies. Its expense ratio of just 0.08% makes it incredibly cost-effective. And SCHD, the Schwab U.S. Dividend Equity ETF, focuses on fundamentally strong companies with 10-plus years of dividend payments. Currently yielding 3.80%, SCHD has become a favorite among dividend investors for good reason. Growth category, the wealth builders. The growth category is where the magic happens for long-term wealth building. Microsoft, MSFT, yields just 0.64%, but here's why it's in our growth portfolio. Dividend growth of 10.22% annually over the past 3 years. When a company grows its dividend that fast, your yield on cost compounds rapidly. Apple, AAPL, offers 0.48% currently, but with $97.29 billion in net income and a payout ratio of only 14.10%, there's massive room for dividend growth. Apple's free cash flow generation is simply incredible. Broadcom, AVGO, is the standout performer here. 80.50% total return over the past year. Even with just a 0.80% yield, its 13.10% dividend growth and position in the semiconductor boom makes it a compelling growth dividend play. For ETF exposure, VGT gives you the entire information technology sector with a 0.46% yield. Technology companies are increasingly paying and growing dividends as they mature, and VGT captures this trend perfectly. Finally, QQQ, the NASDAQ 100 ETF, provides exposure to the 100 largest non-financial companies on NASDAQ. With 82.51% returns over 3 years, it's pure capital appreciation with growing dividend support. Strategy breakdowns. Let me show you how this works in practice. Meet Harry. He's 35 years old and starts investing $500 per month using the 5-5-5 strategy. He allocates $165 to high yield, $170 to balanced, and $165 to growth securities. Strategy 1. Conservative approach, 40% high yield, 35% balanced, 25% growth. Harry prioritizes current income. After 10 years of $500 monthly contributions, $60,000 total, his portfolio value reaches $95,000, generating $3,200 annually in dividends. The high-yield focus provides immediate cash flow, while the growth component ensures his portfolio doesn't stagnate. Strategy 2. Balanced growth, 33% each category. With equal weighting, Harry's portfolio grows to $105,000 after 10 years, generating $2,800 annually. This approach balances current income with capital appreciation. The beauty is in the compounding. Those growing dividends from MSFT, AAPL, and AVGO start making a real difference. Strategy 3. Growth focus, 25% high yield, 30% balanced, 45% growth. Harry emphasizes wealth building. His portfolio reaches $115,000 after 10 years, generating $2,400 annually. While his current dividend income is lower, his portfolio value grows faster, setting him up for larger income streams in the future. If you're finding this helpful, smash that like button. It really helps the channel grow. Here's where it gets exciting. After 20 years, regardless of which approach Harry chose, his portfolio is worth $350,000 to $450,000, generating $12,000 to $15,000 annually in passive income. That's the power of combining dividend growth with capital appreciation. Why this strategy works. The 5-5-5 strategy works because it solves the fundamental problem most dividend investors face, the yield trap. By diversifying across yield profiles, you're not putting all your eggs in one basket. High-yield securities like ARCC and JEPI provide the cash flow you need today. Balanced holdings like SCHD and PEP give you dividend growth with stability. Growth positions like MSFT and QQQ drive your portfolio value higher over time. The key insight? Dividend yield isn't everything. A 2% yielding stock that grows its dividend by 10% annually will out-earn a 6% yielding stock with no growth over time. Microsoft's 0.64% yield today becomes a 6.4% yield on cost after 25 years of 10% dividend growth. This strategy also provides natural rebalancing opportunities. When growth stocks outperform, you can trim and add to high yield. When dividend stocks are favored, you can shift toward growth. This disciplined approach helps you buy low and sell high. Here's how to implement this strategy. Start with ETFs like VYM, SCHD, DGRO, VGT, and QQQ for instant diversification. As your portfolio grows, you can add individual stocks like MSFT, AAPL, and PEP for more targeted exposure. Remember, this is a long-term strategy. Dividend cuts happen, market volatility is normal, and some positions will underperform. That's why diversification across 15 different investments is crucial. The 5-5-5 framework provides structure while allowing flexibility to adjust based on market conditions and your changing needs. Risk management is built into the strategy through diversification across sectors, investment styles, and geographic exposure. You're not relying on any single company or economic moat for your financial independence. All investments carry risk. Past performance is not indicative of future results. Always do your own research or consult a professional. The 5-5-5 dividend strategy proves you don't have to choose between income and growth. By balancing high-yield balanced and growth securities, you create a portfolio that generates passive income today while building serious wealth for tomorrow. Whether you're 25 and prioritizing growth, 45 and seeking balance, or 65 and needing high yield, this framework adapts to your life stage and financial goals. The key is starting now and staying consistent with your monthly contributions. And don't forget to subscribe for more wealth-building strategies like this.